Welcome to Insiders Capital. I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. Joining us today is Andrew Clee, Vice President at Fidelity Investments. Andrew, thanks so much for joining us today.
Thanks, Pierre. Happy to be here.
Now, Andrew, I understand there's been a very big launch.
Yeah.
We were hoping we could get a chance to talk to you about what exactly Fidelity is launching.
Yeah, super exciting time. First entrance into the ETF space in the Canadian market. So we launched a dividend suite. We have 6 ETFs and 6 mutual funds that hold the ETFs available in the market. You might ask, why did we choose dividends? I think it kind of starts with aging demographics. So if you think about the last 30, 40 years, we've seen the baby boomer population accumulate their portfolios to get ready for retirement. What do we think happens over the next 30, 40 years is the deaccumulation phase. So that's relying on their portfolios as sources of income. So if you think about the combination of a targeted approach that gives high yield in a diversified manner, and the combination of low management fees, I think it's a very compelling mix for investors.
What was it that led Fidelity, what was the path that led Fidelity to decide to do this?
Well, I think it's a combination of client demand, so the clients were asking us for it, and we also wanted to bring our expertise alongside our mutual fund business. So if you think about, it's just tools in a toolbox. We're adding the investment expertise to give that to investors. If you take a look at the best institutions, the best pension plans, over the last decade or so, they've all incorporated both active management, quantitative or factor management alongside passive management. So we did a lot of research and development to actually develop these indices. So if you think about the evolution, this may be our first ETF in the Canadian market. We actually hired a full dedicated quantitative equity research team back in 2006. And their job was to help portfolio managers in 2 fashions. So that was identify buy-sell candidates from a quantitative standpoint, and 2, most importantly, was help them with portfolio construction. So fast forward 12 years, we've taken a lot of those fundamental insights from working alongside our active guys, and we've put together a pretty thoughtful portfolio construction methodology that allows us to bring the dividend factor to the front of the page rather than have some sort of concentration risk, whether that's at a sector level, a company level, or a market cap bias. So I think what we've done is we're trying to expand the toolkit, bring those investment expertise to the investors, and that's how we got here today.
Well, it's great when you combine, Fidelity's bench with the dividend factor in particular, because for the last 15 years, for example, the dividend factor has been outperforming fairly consistently in 3-year periods.
Yeah, it's pretty interesting. If you look at the studies, our team's done some thought leadership pieces. It's about 2.1% outperformance versus the Russell 1000 when we look at U.S. dividends. That's about a 3-year time period. But what I love about factor strategies is we're targeting a desired outcome here. So that's dividend yield in this capacity. So if you think about what our active guys do, they're bottom-up stock pickers. They go do the fundamental research. And what we're trying to do here is offer a dividend yield in a diversified manner. So if you take the complementary aspects of that, we got some great stock pickers on the active mutual fund side. And if you marry that with our dividend outcome approach, you get a nice mix in the sense that you can enhance yield, you can still take advantage of that active bottom-up stock picking, and we're just trying to deliver a dividend yield in a diversified manner on the ETF side.
Yeah, you guys have a very deep bench. You got a lot of you got a lot of contributors to that bench, and there's a lot of people who can actually take part in the oversight.
Exactly.
Now, within the lineup, you guys have U.S. dividend factor, and then you've also got the currency neutral. Now, is it a U.S. dollar neutral version as well, so that there isn't the currency effects?
Yeah, so on the currency neutral products, we actually hedge out all the currency risk. So you actually take advantage of just the pure play return profile. And then on the unhedged products, you take on a little bit of currency exposure. So why do clients like that? If you think about historically, in down markets, U.S. dollar is often a safe haven asset because you need to buy gold, U.S. treasuries in U.S. dollar terms. So what we've seen historically is when markets are under pressure, U.S. dollars usually bid, so that means it's going up. So it can help lend to a little bit of downside protection. Alternatively, if you don't want to take on currency exposure, you can buy the hedge product. So that gives you pure play return on the underlying equity returns. There is a little bit of cost of hedging, but it's very nominal. So depending on your views of the market, you can use them tactically or strategically. So we've seen a bit of both.